This is the Brave New Coin Crypto Conversation, hosted by Andy Pickering.
Hi everyone, Andy Pickering here. I'm your host and welcome to the Crypto Conversation, a Brave New Coin podcast where we talk to the people building the future in the Bitcoin, blockchain and cryptocurrency space. Hey team, we have a new sponsor here at the Crypto Conversation, BitGet, one of the world's leading copy trading cryptocurrency exchanges. Yes, indeed. What happens if you've got the funds to invest, but you don't have the time to keep track of the market? You still want to make smart money moves. What do you do? Well, copy trading is a popular choice for beginner traders. You can shorten your learning curve by uncovering tips and strategies from more experienced traders. BitGet's copy trading platform has over 80,000 elite traders to choose from and 380,000 followers just like yourself who are already using the BitGet copy trading platform as a potential passive income stream. All it takes is one click. You can subscribe to an elite, profitable strategist, set your limits, automate your orders, and monitor their trades. I've got some links in the show notes below. One link will take you through to the BitGet sign-up page, give you a VIP discount. So learn all about it for yourself thanks to BitGet. And now it is on with the show. My guest today is Guy Young. Guy is the CEO and founder of Ethena Labs, the crypto infrastructure building a USDe, the first ever global internet bond and stablecoin not reliant on existing banking institutions. Very interesting. Welcome to the show, Guy.
Thanks for having me on, man.
It is a pleasure. Let's do what we do at the beginning of the show, Guy. It'd be great if you could please introduce yourself. I'd love to hear a little bit about your personal and professional backstory and what has led you to founding Ethena Labs.
Sure thing. So my background was in traditional finance. So originally started my career in investment banking, working in London, and then I moved over to a US hedge fund. And that's where I spent the last 5 years, and we were focusing primarily on financial services. So that was looking at everything from banks to insurance companies, specialty finance, and investing across the capital structure into those type of businesses. I had a friend who's a DeFi founder who introduced me to crypto back in 2019. Was investing into it on the side of my day job until midway through 22. When we had the collapse of Luna. Arthur Hayes came out with a thought piece a few days after that where he outlined his vision of how we could try and create a scalable crypto native solution for stablecoins that could live outside of the banking system. And his basic idea was being long Bitcoin on one side and then using that collateral to short the perpetual on the other. Those two positions coming together netted off to create what is a synthetic dollar position. And I read his piece, was inspired by the vision and the way he thought about things, and decided to quit my job to start building out Ethena on the back of that.
Yeah, fantastic. One of, I guess, a few people from traditional finance have been inspired by the many visions of Arthur Hayes, but he's had some. I think I remember the thought piece or blog or whatever you want to call it that you're referring to. And obviously Arthur is he's a reasonably prolific writer and he's an interesting thinker in the space, certainly, isn't he?
Yeah, absolutely. I mean, I had been reading his pieces for a couple of years before that. I think one of the great things that he sort of gets across is really just trying to blend the macro view on the world and how that sort of feeds through down into crypto. And had been a fan of his work for a long time. And actually, funnily enough, part of the idea that he has here, I think, predated thinking about this stablecoin because it was actually sort of used on BitMEX by traders who are trading there with Bitcoin collateral all the way back to 2016. So when you didn't have stablecoin sitting there on BitMEX, the way that people thought about neutralizing their position to get into a synthetic dollar position was actually using Bitcoin to then collateralize the short position on the other side. So people had actually been doing what we're sort of trying to turn into a product now many years before he came out with that piece. And really, this is just sort of like the natural evolution of that, which is tokenizing that trade into something that can then be used as a stablecoin.
And so are you in comms with Arthur?
Yeah, so Arthur sort of led the seed round that we completed a couple of months ago with Dragonfly. He's joined the team as a founding advisor, helping us sort of think through the strategy, the go-to-market, and just ensuring that we have the right relationships at different exchanges, which is a pretty important piece of how the product is sort of put together, as you can imagine. So yeah, we're super thankful that sort of Arthur got behind us to back us, and yeah, obviously excited to work with him on bringing that vision to life.
Yeah, sorry, you're exactly right. I had that in my notes that Dragonfly Capital, but of course, yeah, it just slipped my mind that yeah, it was Arthur is actually behind Dragonfly Capital. So of course, yeah, that all makes sense. All right, well, let's fascinating backstory. So that's brilliant. Let's rewind a bit, I guess, and start from the beginning. So, I mean, you kind of explained the idea, I guess, but yeah, Ethena Labs. What is the vision then?
Yeah, I think it's really just building on the idea that Arthur had. His core idea, as I said, was long Bitcoin on one side and then using a perpetual swap on the other to hedge out the price volatility to give you a synthetic dollar position. We took the idea in his piece and made two fundamental changes to the way that he was thinking about things. The first was that we're starting with staked ETH as an asset rather than Bitcoin. We can jump into the reasons for why that is, but really it boils down to the fact that you have now for the first time a positive carry for being long Ethereum. So when you're long that position and you're getting paid 4 to 6% for being long staked ETH, that obviously looks more attractive than Bitcoin, which has no inherent yield in the underlying product. The other piece for that is actually one of sort of security and safety. So part of the risks of these types of designs is that you could go through periods where funding on the perpetual contract or the cost or amount that you're being paid to take out that short, that does vary through time. So traditionally it's been pretty skewed to the positive side where you get paid to put on that short, but you do have periods where you actually have to pay out to hold that position. And so obviously having that embedded yield within staked Ethereum now also just adds an additional margin of safety to the product itself. I think the second change that we had with Arthur's idea was just thinking about the underlying custody of the assets. So he was pretty insistent, and it's something that we agreed with as a team, that you needed to access centralized liquidity in order to be able to get the product to scale. So you've seen previous iterations of this type of design attempted to be brought to market fully on chain. So you've had other projects who have tried to put together this delta neutral stablecoin, but only using decentralized exchanges on Solana and on Ethereum. The problem with that is that you just don't have enough liquidity on chain to be able to scale it to a size that's meaningful and into the billions, which is where we sort of see the demand for a product like this. And so if you accept the fact that you need centralized liquidity, we asked ourselves the question of how we could do that in a risk minimized way for our users on the other side. And since the collapse of FTX, we've seen some interesting sort of developments around the way the custody solutions are being brought to market within crypto, where you're able to disaggregate the custody of the underlying assets and the execution and settlement of the trades. And so what that means is that you can hold the assets sitting off of a centralized exchange server, but still use that collateral as the margin instrument to take out the short. And so for us, that was a pretty huge unlock to basically make commitments to our users that we could keep their assets off of centralized exchanges and just reduce the counterparty risk to those entities.
Yeah, very nice, Guy. And I suppose, of course, the other reason why you're using Ethereum here as well is, I suppose, it's DeFi is growing on all sorts of different chains, different ecosystems across the crypto space, but primarily still dominant on Ethereum.
Yeah, that's right. And I think it's part of what we find so interesting around DeFi, which is just the composability element, right? So stable coins that can exist just on exchanges. yes, it's interesting and it's extremely useful to have a trading pair that you can go back into dollars. And that's part of what's driven Tether's success to grow to $80 billion. Really, the function that they provided was the holy grail of basically being money on exchanges. But actually, when you start to take an asset like a stablecoin, and then more interestingly, a stablecoin with a yield, and you start to use that and compose with it in interesting ways throughout DeFi, for me, that's actually the exciting bit of what you can start to take this asset and start integrating it through DeFi. Because if we think about the way that DeFi sort of functions today, really it's working off of cash sitting behind most of the balance sheets within those projects. So whether it's the backing to something like MakerDAO, where you have USDC or Frax, and then a lot of the money markets, it doesn't make a lot of sense, right, that these things have no yield that's embedded into them. If we think about it in an analogous reference point within the real world, insurance companies, banks, they all have treasuries instead of cash. That's like their form of cash. When they need short-term liquidity, they can take those treasuries to the repo market and sort of satisfy their short-term liquidity requirements. But within DeFi, you don't really have that bond-like instrument, which sits there on the balance sheets of those businesses. And we actually think that yes, the stablecoin is an interesting product that comes out of these two positions. But actually, the more interesting product is this idea of an internet bond, which is basically a stable position with an embedded yield, and that yield is derived from crypto native sources.
Yeah, that's interesting. The idea of the internet bond. So just explain that a little bit more and where the yield comes from.
Yeah, sure. So I guess there's two sources to that yield. You've got the staked Ethereum returns that I described. So you're long Ethereum on one side, and then you also get paid to put on that short, typically through time. And that does vary. To be clear, that sometimes does go negative, but most of the time that is positive. So if you look back on like the last 3 years of data, and this includes the bear market of 22, roughly you get paid around 7% to be short Ethereum. If you look at how those figures are sort of stacked up this year, you've had like a range of roughly 4 to 6% on staked ETH returns, and the funding on ETH contracts is averaged out at around 7 to 8%. So when you add those two figures together, it's actually a pretty interesting unlevered yield in the low teens. And that's when we're sort of at the bottom of the crypto rate cycle, right? And the top of the rate cycle in the real world. And so we think it's quite interesting actually having those two sources of yield packaged up into a stablecoin product, which has an embedded yield, and then starting to integrate that in interesting ways throughout DeFi. I think the one other comment I'll just have around that yield, which is pretty interesting to people who exist outside of crypto, is the idea that yield is actually negatively correlated to yields in the real world. So what we typically saw when rates came down in the real world during the last cycle was that obviously activity on chain picks up when rates are down. People are trading more, speculating more, and staked ETH returns you'd expect to increase. And then similarly, you actually get paid more to take out those shorts because the market is wanting to be more long as rates go down in the real world. And so if you sort of back tested that and said, where would that yield be in the first half of 2021, for example, that's like closer to 25% on those two things coming together. So I think the most interesting component of this internet bond is actually the fact that the yields themselves would expect to be negatively correlated to rates in the real world, which is something that I think will become more interesting as we sort of expect rates to fall in the real world in the next sort of 12 to 24 months.
And how do you see the internet bond, I guess, kind of growing over time as more people look at it as a kind of potential savings instrument? Who do you expect are the different user segments that might start to use it in that way?
Yeah, I think it does appeal to quite a broad range of different entities. So I think, as I mentioned within DeFi, we see this as a superior asset to USDC to be plugging into different types of balance sheets. So whether that's sitting behind some of the other stable coins that exist within DeFi, does it make sense to for example, create DAI from MakerDAO or Frax's stablecoin around USDC, which has no yield, or should you wrap it around something which is more censorship resistant, crypto native, and actually has a yield that's attached to it as well? So I think part of where we see this asset sort of integrating through the rest of DeFi is actually into different stablecoin projects and money markets as well. Outside of that, I think there is interest from sort of hedge fund type capital and traditional finance, which for the reasons that I mentioned around the different qualities of that yield and the fact that it's uncorrelated or at least negatively correlated to rates in the real world. That's actually just an interesting sort of structured product for those type of entities to come in and participate. So I do think it's pretty broad in terms of the reach of where that product might go.
Yeah, absolutely. And I guess maybe speak to the same in terms of the stablecoin USDe. How are you going to, I suppose, scale that outside of existing kind of DeFi native users and take it? I'm sure the eventual market is really the world, right?
Yeah, I think one thing that does look quite different with us and other stablecoin issues is actually the supporters that we've had coming behind it. So a key piece that Arthur outlined in his thought piece was you want this project to be broadly owned by exchanges across the space. You didn't want it to be owned by a single exchange entity. And we put quite a bit of work into actually getting those exchanges on board as investors. So I think it might be one of the first times that they've all come together to support a single project for our seed round financing, where basically 90% of the derivative market is supporting us as a project. So the reason I do mention that is we also think about those exchanges as very interesting distribution channels. So I don't know where you would put the number of users within DeFi at the moment. I would conservatively say like actual daily users is probably closer to 10,000 rather than in the millions. Yeah. And if you look at those exchanges, they're sitting on somewhere between 100 to 200 million customers, depending on which one you're looking at. And so you sort of look at that discrepancy and think to yourself whether it makes more sense for you to try and chase customers yourself, or actually just provide a product that's useful to these exchanges to then distribute to 100 million users on the other side themselves. The reason I think our product looks quite compelling for these exchanges is twofold. So the first is it is fundamentally different in terms of the custodial risk to a normal stablecoin, right? Where when you saw BUSD get shut down with Paxos at the beginning of this year, Binance's operations with their BUSD were basically halted over a weekend because a US regulator wanted to come in and shut that down. Having something that lives within the crypto ecosystem and is entirely sort of disconnected from existing banking rails is pretty useful for an entity like that, right? Where you can look at this and say that this is an interesting insurance option to have alongside some of the other fiat stablecoins that they have on their exchange. I think the second piece is actually just the fee structure in terms of how the stablecoin is created. So if you think about it, every dollar of notional that we create of USDe, it necessitates us taking out a short position on those exchanges, which obviously comes with fees associated with that. In addition, Tether and USDC pretty much fully internalize all of the return of that product to themselves. So that's part of the reason that you've seen Tether generating billions of dollars of profit this year, is that they obviously share out none of that return with the exchanges on the other side. And so we're pretty laser focused on actually sharing some of the return that's being generated here with those exchanges, so that they're sort of aligned with us to actually distribute the product on the other side. So yeah, I think that's like a big angle for us is just thinking about these integrations with exchanges and really providing them a solution that we think is compelling to then distribute to their users on the other side.
Got it. Thank you, Guy. But look, you alluded to, I guess, the kind of the heat that is perhaps coming on Binance at the moment. Certainly seen regulators take a look at Tether at different times. What is the kind of, I guess, how do you think about the regulatory risk that may come and go in regards to the stablecoin space?
Yeah, I think we've already actually seen some of those effects play out this year. If you looked at sort of the distribution between onshore and onshore being defined as US issuers of stablecoins regulated in the US, at the beginning of this year, it was roughly 50-50 between onshore and offshore. And with what we saw with Chokepoint 2.0, the collapse of SVB, Paxos getting shut down, and then general market share loss from USDC through the year, that number's actually shrunk to 25% today as it stands. So it's a pretty mind-boggling stat if you think about it, that 75% of stablecoin issuers of US dollars actually exist outside of the shores of the US. And I think that that's basically just the outcome of what you've described there, which is the hostile regulatory environment within the US actually pushing innovation and pushing products offshore. So I don't have a differentiated view in terms of where that sort of ends up and how US regulators approach this going forward. What I would say is it does seem quite strange to me that really the business model of the US is importing goods and services and then exporting the dollar to the rest of the world. And this technology is clearly one of the most interesting ways to actually facilitate that. So it would seem quite strange to me that the US doesn't want to, if not embrace, but at least have more control over how that is undertaken. And so I do think it is one of the higher priorities when it comes to how they're thinking about dealing with crypto. Stablecoins, I think, is probably at the top of that list.
Yeah, absolutely. And look, this is it's kind of a funny way of thinking about things, but, it's kind of probably how Arthur would think about it. It's like, he's written about this kind of stuff before, like, the coming digital currency wars. You have perhaps a Bitcoin in one corner as the kind of, the largest decentralized censorship resistant a blockchain in the world. Then we'll have a variety of stablecoins competing, coming, rising and falling, and then very soon probably central bank digital currencies. Do you think that is likely to play out?
Yeah, I think it's like the obvious battleground, right, between not only crypto and governments, but then I think the third entrant here as well is actually Web 2 or like traditional finance incumbents as well. So
yes,
you've seen those players at the bottom of a bear market, right, stepping up and actually doing more, and it's always related to stablecoins, whether it's Visa and Solana last week or PayPal a couple of weeks before. It's interesting that these guys are doing this right in the middle of a bear market. This isn't sort of like trying to grab onto the hype, like you see with some of those partnerships at the peak of the market. This is them making very thoughtful and strategic decisions around how they're repositioning their business to actually embrace this type of technology when hype is at the absolute bottom, right? And so, yes, I think this is definitely going to be the battleground between censorship-resistant money from crypto, incumbent issuers of stablecoins within crypto, which cross over into sort of the battleground with Web 2 and traditional finance. And then, as you say, CBDCs sort of step in as this sort of alternate option there that comes a bit further down the line. I think the point to emphasize here is that they all look very different. I think will play different functions and have different properties that appeal to different people. I do think they coexist going forward. The question is just what sort of percentage of total share do each of those different qualities sort of command going forward. And I think the interesting piece that we think we're solving for is really a niche outside of all of those different things that we've described, because it is truly crypto native and lives outside of those systems that everyone else is competing within.
Yeah, absolutely. Look, Guy, you've said a couple of times that different parts of traditional finance are increasingly interested in what is possible now in the DeFi space, but I'm sure there are still large parts of traditional finance as well, perhaps prior colleagues of yours even that would still be a little bit more skeptical, if not downright dismissive of the distributed ledger technologies, shall we say. I'm just curious, because you have a better insight than most on this. How would you characterize the kind of traditional finance view of the distributed ledger space?
Yeah, I think after what we've seen unfold in the last 2 to 3 years, it's actually a reasonable position to take from them. I mean, we positioned this as an open, transparent system, and then it collapsed under total opacity, right, with different centralized entities failing through the last few years. Yeah. So I think that there is natural skepticism around the way that it was marketed outwardly, and the types of entities that were failing, being totally centralized and opaque in the way that they presented a bunch of different things. And I think with DeFi in particular, there's obviously interest, but there's just, again, quite a lot of caution because there's just consistent hacking, losing of funds. And it does seem like, I think, too much of a Wild West for them to engage with serious funds. And so even some of the funds that you see crossing over between traditional finance and crypto, they have very strict sort of controls and parameters in terms of what they can actually interact with on chain. And so I think we're actually, DeFi in particular is actually probably 5 to 10 years too early for those type of players to be interacting with in a totally permissionless way. And so what I think we're starting to see is actually DeFi sort of split into two, where you have the Wild West type DeFi, which is what was that first iteration through 2018, 19 to 2020. And then there's sort of a second permission version that's sort of starting to grow at the moment, which includes all of these different categories like RWAs and stuff. And that obviously has just a different set of controls that sort of exist around it. So I'd say that the position of skepticism that you sort of suggested is probably the right one. But I do think that we are starting to see the early innings of different forms of permission DeFi, which will see them engage more going forward. I think stablecoins do live outside of that almost entirely, where it's very easy for people to see the value proposition of what stablecoins do provide. It doesn't take much explaining or showing people to sort of see that it's a product that's 10 times better than what exists today. And so I think that is something that is quite separate from different bits of DeFi when it comes to the traditional finance players coming in.
Yep, absolutely. Very good thoughts. Thank you, Guy. Well, look, as we finish off this part of the podcast, again, look, just please make the case again for what you guys are creating with the USDe stablecoin and the internet bond. And for people that are intrigued and unfamiliar and perhaps want to know more, well, what should they do? Where should they go?
Yeah, sure. So I think the summary on our side is really, what is crypto trying to do? It's trying to create a parallel financial system that exists outside of the existing one. We think that to truly enable that, you need to make sure that the most important financial instrument is not tethered to the existing system, and that's stablecoins for us. And so we do sort of see it as one of the most important challenges to be solving as a space, which is creating crypto native money that we can actually rely on as an industry that is totally separate from the existing system. And so we hope to play some small part in that, and do believe what we're doing is sort of important for the space more broadly. In terms of where you could find us, the Ethena Labs Twitter is Ethena_Labs, and then mine is at leptocratic_, which hopefully we can leave in the show notes.
We absolutely can. And of course, the Ethena website is ethena.fi, but that, of course, it will be in the show notes, or is in the show notes, listeners. I think we'll go to a very quick break, and then we'll come back. We'll have some fun. We'll finish off by running Guy through the very famous crypto conversation hot take round. Back in 1 second.
Look, we'd all like to say we're pro traders, but the reality is we're probably not. But with BitGet, you don't have to be. Why? Because BitGet is the world's largest copy trading exchange. Instead of you muddling through it on your own, feel confident. BitGet allows you to automatically copy trade from over 80,000 elite traders with 24/7 support on our secure copy trading platform. Start following expert traders on bitget.com. Check for details in the show notes and join BitGet today.
All right, we are back, and I'm with Guy Young. Guy, of course, is the CEO and founder of Ethena Labs, a crypto infrastructure company building USDe, the first ever global internet bond and stablecoin, not reliant on centralized banking institutions. Yes, indeed. Guy, I like to finish each podcast with a quick round of rapid-fire crypto conversation hot takes. Are you up for it?
Let's do it.
Let's do it, Guy. All right. Bit of a funny one, but I know Arthur Hayes, he's a big Bitcoin guy, but where would you say that you sit on the Bitcoin maximalist to multi-chain opportunist spectrum?
I sit pretty far away from a Bitcoin maximalist. I own Bitcoin. I think it's useful. I think it's important, but I'm definitely not a big Bitcoin maximalist, and I'm building products that live on Ethereum. So yeah, that's where I sit. So.
Understand. What would you say then is your firmest conviction crypto opinion, Guy?
It's a pretty negative one, but I think crypto is going to create a lot of value, but it's going to capture almost none of it. And so I think a lot of what we see within crypto is going to provide fundamentally useful things for consumers, but have very little way of actually capturing that value to either the protocols or businesses that provide those services.
Interesting. Yep, it kind of makes sense though. Okay, well, look, Bill Gates famously said that we tend to overestimate what we can accomplish in 2 years and underestimate what we can accomplish in 10. With that in mind, anything you like, DeFi, Web3, stable coins, money, the future of money. What does it all start to look like in 10 years' time?
Yeah, maybe one sort of pretty optimistic prediction is where I sort of see stablecoins ending up over the next 5 to 10 years. I think one reasonable reference point is maybe the size of dollars that exist outside of the US in the euro-dollar system. I think estimates that we've seen pretty conservatively put that number at around $10 trillion, which is around 100x from where stablecoins are today. And so I think we think of stablecoins at $120 billion market cap as being pretty large, but I actually think that there's still at least 100x left in that market over the next 10 years.
Very nice. All right, Guy. Flip side of this, of course, is a quote by William Gibson, who famously said that the future is already here. It's just not evenly distributed. Can you think of an example of the future being here right now, Guy? But most people aren't aware of it.
Yeah, I think without sort of trying to beat the same drum around stablecoins, I think it really is here as a form of money which is fundamentally more efficient, easy to use, and cost effective than the way we transfer and settle money in the real world at the moment. I think what you've seen in the last few months in terms of existing payment and settlement networks engaging with this type of technology is really the first innings of them embracing stablecoins to actually truly replace all forms of dollar settlements around the world. And so I think the future is here with stablecoins, but we're just at the very early innings of seeing it sort of proliferate more broadly.
Absolutely. Very well said. All right. Final question for you, Guy. What is your favorite science fiction? A book, a film, or TV show?
I must admit, I don't actually read, watch, or listen to any science fiction. I read a little bit, and it's mostly related to economics, which is what I studied at university, and sort of behavioral economics as well. So on science fiction, I'm afraid I don't have an answer for you on that one.
That's all right. You don't do the occasional Netflix, Apple TV, anything like that? Just when we're chilling from our economic study?
I actually don't even own a TV in my house, so I think
you're very disciplined guy. Yes, I like it. Look, this has been a pleasure talking to you today, Guy. Thank you so much for coming on the show to chat all things Ethena Labs, stablecoins, USDe, all that good stuff. Again, just close it out by, again, please shout out the various Twitter profiles that you mentioned before, and where people should go to talk, learn, and discuss Ethena Labs and stablecoins. Of course, the links are in the show notes, but shout them out.
Sure, it's Ethena_Labs on Twitter, www.ethena.fi as the website. And then I'm on leptocardic_ on Twitter as well.
Awesome. Thank you so much for coming on the show, Guy. All the best, and bye for now.
Appreciate it. Thanks, man. Cheers.
All right, there you go. That was Guy Young from Ethena Labs. Yeah, very interesting. Stablecoins, just, hard to imagine a future where various stablecoins don't just begin to take over the global money markets. Feels a little bit inevitable. And Arthur Hayes, I should I'll see if I can dig up that original blog post that Arthur wrote about what a real stablecoin should look like. See if I can put that in the show notes as well, because that'll be worth reading again. Certainly did inspire Guy. Arthur, well, he's a flamboyant writer. Has a way with words, doesn't he? Interesting. All right. Well, thank you for listening to the podcast. Thank you for listening to this episode. Please make sure you're subscribed to the Crypto Conversation in whatever podcast app you are using. But that is it for today. This was the Crypto Conversation for Brave New Coin.